So here's a mystery for you. Why is arguably the greatest investor on the planet suddenly hoarding cash? I mean, this has Wall Street completely buzzing. And you gotta wonder, could it be a warning sign for the rest of us? Let's dig in and find out. Yeah, we are talking about the one and only Warren Buffett. And the question really is simple, but the answer, well, that's what we're here for. Why is a guy who's famous for buying stuff suddenly not buying anything? I mean, what does he see that maybe we don't? And look, when I say record breaking, I really mean it. His company, Berkshire Hathaway, is sitting on a cash pile of, get this, over $381 billion. That's not just a little record. That's more than double its last peak. This isn't some small tweak to the portfolio, you know? This is a massive move. It feels like a giant flashing warning light. Okay, so what's really driving this billion-dollar question? For Buffett, it all boils down to one simple thing, a really powerful signal he's picking up from the stock market. Okay, so what you're looking at here is something called the Shiller-Cape ratio. It's kind of technical, but all it really does is compare stock prices to how much money companies have been making over the last 10 years. And here's the kicker. Right now, that ratio is higher than it's been since the dot-com bubble back in 1999, right before the crash. For a value guy like Buffett, this is a huge red flag. It's basically screaming that stocks in general are just too expensive. And that's why he's having such a hard time finding any good deals out there. This cautious approach from Buffett, it leads us right to one of the oldest things in the investment world. I'm sure you've heard it, but it's absolutely at the heart of his strategy right now. We're talking about the cash is king rulebook. So what does cash is king actually mean? Well, in short, it's all about having money that's ready to go, what we call liquid assets. When you have cash, you have options. You can survive a downturn, sure. But more importantly, you have the power to jump on amazing deals when everyone else is panicking and selling. It's basically your financial firepower. And trust me, this is not some new, trendy idea. It's a lesson that's been learned the hard way, over and over again throughout history. The phrase has actually been around since the 1890s, but it always makes a big comeback whenever there's a crisis. Think about the '87 crash or the Great Recession in 2008. History just keeps proving that when things get tough, the people holding the cash are the ones who come out on top. But here's the thing. Holding cash isn't just about sitting back and waiting for things to fall apart. No, it's an active, really deliberate strategy. It's all about playing the wait-and-see game. Believe it or not, there's a whole economic theory behind this. This quote from Nancy Stokey nails it. When there's a lot of uncertainty out there, about the economy, politics, whatever, it's actually the most rational thing in the world to just stop. You just pause, you wait for the fog to clear before you put your money to work. And that academic idea, it translates directly to the trading floor. Listen to what this market analyst Axel Rudolph says. Sometimes the absolute best thing you can do is nothing. Just sit on the sidelines, wait, and see what happens. Sometimes not trading is the best trade. Okay, so this whole wait-and-see thing is part of a real pro strategy called tactical asset allocation. Let's break down this table. Your long-term plan, your strategic mix, might be to have 55% of your money in stocks. But if you think the market looks pretty strong right now, you might make a short-term, tactical move and bump that up to 58%. Same with bonds. Maybe your plan is 35%, but you're a little bearish, so you tilt it down to 32%. See? It shows that holding on to cash isn't just being lazy, it's part of a very active, thoughtful game plan to navigate the markets. All right, so holding cash sounds pretty smart, right? It sounds safe. But, and this is a big but, there's a huge catch. Sitting on the sidelines is not free. In fact, it comes with a very real and often very big cost. And this chart, wow, it makes that risk crystal clear. Your cash, it's earning you pretty much nothing. Meanwhile, a diversified portfolio is probably growing over time. And then you've got that monster over on the right, inflation. It's literally eating away at the value of your cash every single day. That's what we call opportunity cost. And believe me, over time, it adds up to a ton of money. This is super important, okay? We have to be really clear about the difference between Buffett's strategic patience and some really common investor traps. Are you holding cash because you think you can perfectly time the market bottom? Yeah, that's a trap. Are you holding cash just because you're scared of a recession? Another trap. See, these are emotional moves, not smart strategies, and they're the reason so many people miss out on the best gains. So, what's the takeaway here? How do we put all this together for ourselves? Let's see what Buffett's moves can teach us about our own cash strategy. Okay, so there are three really big lessons we can pull from his playbook. Number one, don't go sell everything. I mean, he's a net seller, yeah, but he still owns hundreds of billions in stocks. Number two, don't just assume everything is overpriced. He's still out there buying shares in a few great companies he thinks are a good deal. And number three, and this is probably the biggest one, always have some cash ready to go. You want to be prepared to pounce when a great opportunity finally shows up. It's all about balance, not panic. So, what are the smart reasons for you to hold cash in your own portfolio? Well, first off, your emergency fund. That is absolutely non-negotiable. We're talking 3 to 6 months of expenses. Second, if you have a big purchase coming up soon, like a house or a car in the next year or two. And finally, just for peace of mind, having some cash can be the very thing that stops you from freaking out and panic selling everything when the market takes a nosedive. Think of it as your stability fund. Which brings us to the final and most important question you have to ask yourself. Right now, in this really uncertain market, is the cash in your portfolio a safety net? Something that gives you stability and the power to jump on opportunities? Or has it become an anchor, just weighing you down and killing your long-term growth? Seriously, how you answer that is going to make all the difference.